Last week, it was announced that Chelsea's new owners raised debt finance to fund the operations of the club. What does this mean for the club, and how does it compare to the previous ownership? Todd Boehly and Clearlake Capital have raised £800 million of debt in the form of £300 million of a revolving credit facility, which is essentially an overdraft that you can pay into to reduce or draw down from, and £500 million of a term loan to fund the growth of Chelsea Football Club under the new ownership structure. Under the previous ownership structure, Roman Abramovich provided the club with a £1.5 billion interest-free loan. What do we know about this current deal? The magnitude of the loan at £800 million is approximately half of that of the previous ownership. But we know that the new ownership structure is looking to protect the club. The loan hasn't been taken out by the club as far as we're aware. And it also appears that there's no club assets secured against the debt. It appears that the ownership are trying to shelter the club from the interest cost of the debt. If, however, the debt was secured against one of the club assets, the UEFA rules state that regardless of the entity taking out the debt, the interest cost would have to be reported to UEFA as part of the break-even calculation. So how will the funds flow to the club? If the new ownership structure want to operate at a break-even deficit or a loss in accounting terms, once relevant reliefs have been considered, there will need to be a continual injection of equity to cover the previous losses. The alternative is for the shareholder to put a loan into the club. That could be and is likely to be interest-free based on what the club's ownership have said. The word debt has a bad reputation when it comes to football finance, but is equity funding sustainable for the long-term future of the club? No matter how rich your owners are, equity funding continuously year after year provides a reliance on that ownership structure, and that is exactly the opposite of a sustainable business model. Debt is normal when it comes to a sustainable business. Being able to manage that debt, service the debt, and make repayments when necessary, that's what's key. What are your thoughts about how your club should be funded? Do you prefer debt or equity, or potentially a mix of both, which is likely to be the model of the new owners of Chelsea Football Club, being able to utilise the debt and potentially make repayments whilst also sustaining the equity requirements of UEFA's financial rules? Leave your thoughts below in the comments. If you like the video, please hit like and follow us for more. My name's Neil Wood and I'm a football finance professional.